If we look at our leverage ratios are always an interesting item, as all the ratios are in reality. But leverage ratios instantly bring a thought to many people's mind. Leverage, too much debt, risk. That may or may not be the case. That's why we have several different ways to look at leverage. There's the total debt ratio, where we're taking the balance sheet approach of taking our total assets minus our total equity for the liability or the numerator calculation. And if you remember our initial definition of a balance sheet must balance, and it is total assets minus total liabilities equals total equity, or total assets equals total equities plus total liabilities. So that's all this is. What do we have in the way of assets? What do we have in the way of equity? The difference must be our debts. Our total liabilities, total debts, divided by our total assets will give us our debt ratio. That is an important metric, again, over time. Even if this ratio is increasing over time, that is not necessarily a negative. We have to look at this in proportion to the rest of the organization. If we look at our equity multiplier, which is used in the DuPont approach to looking at and calculating return on equity, it's what do we have in assets that are being financed effectively by how much owner's capital, the total equity. Over time, is this static? Is this growing? Is it declining? And why? Times interest earned, or TEI as it's abbreviated, is one of the first things that our lenders look at. Why? Because lenders want to be comfortable with the relationship between our operating profit, the EBIT, and the amount of interest we must pay them. What a banker looks for, one of the very first ratios they calculate, as soon as they look at the income statement, is this ratio. If the times interest earned ratio is static or growing, it makes the bank comfortable. It says the company's profit, operating profit here, EBIT, is growing at a higher rate than is the interest obligation to the organization, to the bank. That's what a lender wants to see. If we move to the profitability ratios, these are probably the only ratios that most investors look at least initially. The third one down, the return on equity, or ROE calculation, is probably the most commonly calculated ratio in the world. Why? Because we have over 1 billion investors in the world, and every investor knows how to calculate net income from the income statement divided by equity from the balance sheet. They want to see on a proportional, on a ratio basis, for the given period of time, for the given year, did the organization that they're invested in create enough value for what they're expecting? So even if investors know nothing about finance, they know this ratio. So every investor says, I put my money in X organization, I want a 12.5% annual return. So let me look at the income statement and the balance sheet for these two numbers. What's the net income? Let me divide that by the equity on the balance sheet. Does that equal at least 12.5%, at least what I want? Why do they do this? Because an investor who may have no real impact and input on our organization wants to make sure that they are receiving, either in cash through cash dividends or through increase in the value of the organization and therefore their shares, the return they expect. So this is the one that you see frequently quoted in annual reports. This is the one that you'll see so frequently quoted in the stock market, because it's what everyone is interested in first if they're outside the company. and an investor. The return on assets is equally important, but much more an internal focus. ROA tells us, are we achieving the level of success, the level of income we anticipate by optimizing the use of our assets? If the ROA is at or above industry norms, it tells us how efficiently we're using the assets in our organization. Our profit margin, of course, is something that we're always quoting. Are the sales we're creating generating the income we expect? Are the margins satisfactory? Then if we jump down to our operating profit margin, we go from a net income up to our operating profit. Now the difference between these two, profit margin is the net of the organization. Operating profit margin is the net based on management choices, management decisions. If you remember our discussion on the income statement, everything on the income statement down to EBIT is driven by management choice, management decision. Everything below there, interest and tax, is pretty much out of their control. So although profit margin is always very important, that truly is the bottom line, our operating profit margin is one indication of how well management is making choices and implementing those choices. And then, of course, another comparison back to working capital is NI, which stands for net income, in relationship to our net working capital. Is our use of working capital generating the net income that we anticipate? It's another indication of how well we're managing our short-term assets to help drive our long-term success. Then the last two, the numerators, are net income before tax. In other words, our operating returns compared to both our equity and our assets. Similar to ROA and ROE, but it's a pre-tax number where ROA and ROE are post-tax numbers. So profitability ratios are always viewed emotionally, if you will, both externally and internally. Are we achieving the net results that we're in business to achieve? In addition to all of the non-financial goals every organization has, we have to achieve a minimum level of profitability to stay in business, and a higher level of profitability beyond that to be able to grow and achieve other things. So that's why the profitability ratios are always a very important segment. The last grouping is our market ratios. Now, market ratios have both good and bad. First of all, market ratios can only be calculated if an organization is listed or public, because that's the only way there is a market price. If we don't have a market price, how do we know what the price to earnings ratio is? We can't. And even the earnings per share, or EPS as it's frequently abbreviated, it's important to calculate what the earnings per share are, but we have to remember that the denominator is the number of common shares, assuming they also have preferred shares, those would be eliminated, outstanding, in other words, already issued. Because if you look closely at the balance sheet, down in the common share area, you will see sometimes there are shares that are authorized but not issued. That means they're not in the marketplace, which means those are not included here. Earnings per share, if the number of shares in the marketplace does not change, might be a reasonable measure of return, of success over time. But please remember that some organizations either sell additional shares during the year or might even buy some of their own shares back during the year. So the earnings per share must be calculated in a consistent manner. What were the number of shares in the marketplace at the beginning of the period? What were the number of shares in the marketplace at the end of the period? If that's not consistent, because either a buyback or a sell, then the EPS must be adjusted to take that into consideration. So please keep those in mind. So that's what we talk about. Those are the key ratios. Now, I do want to remind you that these are only some of the more commonly used ratios. You can create literally thousands of ratios in analyzing any organization. You must determine which ratios are most important to you. Which ones are going to tell you the most about the particular organization that you're analyzing. So start with these, eliminate any that you don't think tell you enough, add in any additional ones that you think are consistent, true metrics, and then you have your baseline. So if we take these ratios to tell us something truly important and look at them a little bit differently, we mentioned previously the operating cycle and the cash cycle. The operating cycle measures for us in days the period between when we buy inventory and when we sell it. That's step number one. When we sell it, it turns into an accounts receivable. So from the day we create the receivable until we collect that, that entire number of days combined is the operating cycle. So that's why when we were looking at our utilization ratios, we needed to calculate both the inventory period and the accounts receivable period. So there's our operating cycle. But in most situations, we don't pay for the inventory in advance, or even when through most operations, we pay at some point down the road. We need to also calculate our accounts payable period. The accounts payable period, the number of days we choose to take before we pay our payables, must be subtracted from the operating cycle in order to calculate the cash cycle, the actual number of days that our cash is outstanding. And the Excel model that I created for you, which has the formulas in there, only needs 5 simple inputs. With those 5 inputs, you can calculate your operating cycle and your cash cycle and compare it to what you'd like it to be, what it has been, or its industry peer group. Very important, because that's the most critical element in looking at and managing our working capital, our cash. So in our example here, and you have this Excel model, we put in our revenues and our cost of goods from the income statement. We put in our receivables, inventory, and payables from the balance sheet. The formulas are built in, but they're also written here to the right. We can calculate very quickly that DSO, our days sales outstanding, is 73. That tells us it's taking us on average 73 days to collect our accounts receivable. And it's taking us 116 days to turn over the inventory, to get in a piece of inventory and turn it over. Now, 189 days, I don't know if that's good or bad, because I don't know the industry. If this is machine tools, this would be world class. This is fantastic. If you have a fresh bakery, this means you're bankrupt. So you can see the numbers alone don't tell us everything. The numbers alone have to be compared to a baseline, and they're very industry specific. So just to finish the model, then we look at our payables turnover. In this case, 91 days is our DPO. So our cash cycle, the number of days our cash is outstanding from the time we pay for our inventory until we collect our receivables, is 98 days. Operating cycle of 189, cash cycle of 98. 2 critical items for us to determine whether that's good enough or not. The same thing with our days sales outstanding, days inventory outstanding, days payable outstanding. So in this simple model, you have 5 key numbers that you can use to determine if an organization is liquid enough, if they're managing their working capital assets appropriately for the industry, for the timing, for the cycle.